If you have never invested a single dollar, not because you don't want to, but because nobody ever showed you how, this is the video that fixes that. Here is the number that makes this urgent. The average American who starts investing at 25 and contributes $400 a month until 65 retires with approximately $1.4 million. The average American who waits until 35 to start, with the same $400, the same investment, the same discipline, retires with $540,000, $860,000. Gone. Not from bad investing, from waiting. Every month you are not invested, you are not in a neutral position. You are falling behind a version of yourself who started today. This video is going to walk you through exactly how to start, the account to open, the fund to choose, the amount to start with, and the one rule that makes everything else work. No jargon, no assumptions, step by step. We are covering why the stock market is the right starting point for most Americans, the exact account type to open based on your situation, the only type of fund beginners should own, how much you actually need to start, and the one habit that separates people who build wealth from people who mean to. This is wealth clarity. Let's get into it. Let's start with the most important question. Why invest in the stock market at all? And why 2026 specifically? The US stock market has returned an average of approximately 10% per year over the last 100 years. After adjusting for inflation, the real return is closer to 7%. That means money invested in a broad US market fund has historically roughly doubled in real terms every 10 years. Nothing else available to ordinary Americans does this. A savings account currently pays between 0.01 to 5% depending on the type. A US Treasury bond pays somewhere between 4 and 5%. Real estate requires large capital, active management, and illiquidity. The stock market, through a simple index fund, gives you partial ownership of thousands of American companies, their profits, their growth, their dividends, for an annual fee that can be as low as 0%. There is no perfect time to start. There was no perfect time in 1990, in 2005, in 2015, or in 2023. Markets went up. Markets crashed. Markets recovered. Every crash in US market history has eventually been followed by a new high. The people who stayed invested through every one of those crashes came out ahead of the people who waited for certainty, because certainty never came. The best time to start investing was 10 years ago. The second best time is today. And the specific reason 2026 matters is that every year of delay between now and your retirement compounds against you at the exact rate the market would have compounded for you. At this point, most people watching this video have one of three thoughts. I don't have enough money to invest. I'm too old to start. The market is too risky right now. Here is the honest answer to all three. You can start investing at Fidelity with $1, not $1,000. $1. You are not too old. A 45-year-old investing consistently for 20 years with no prior investment history will have a meaningfully better retirement than a 45-year-old who waits 5 more years for the right moment. And the market is always risky right now. It was risky in 2010 during European debt fears. It was risky in 2020 during a global pandemic. It was risky in 2022 during the inflation spike. It recovered every time. The risk of not being invested is greater than the risk of being invested for anyone with a time horizon longer than 5 years. The excuses are understandable. They are also expensive. Let's move past them. The first real decision is not which stock to buy. It is which account to put your money in. This matters because different accounts have different tax treatments. And the tax treatment of your investments is one of the most powerful variables you can control. There are 3 account types most American beginners need to understand. The first is a 401k. If your employer offers one, especially with a matching contribution, this is where your first investing dollar should go, up to the full match. An employer match is a guaranteed return that no market investment can compete with. If your employer matches 50% of contributions up to 6% of your salary, contribute that 6% first. Always. The second is a Roth IRA. If you are in a lower tax bracket now than you expect to be later in your career, which describes most people in their 20s and early 30s, A Roth IRA is one of the most powerful accounts available to Americans. You contribute money that has already been taxed, it grows completely tax-free for decades, and you pay zero tax on withdrawals in retirement. The 2026 contribution limit is $7,000 per year for most people. Open one at Fidelity, Vanguard, or Schwab. The third is a taxable brokerage account. If you have captured your employer match, maxed your Roth IRA, and still have money to invest, or if your income is above the Roth IRA limit, a taxable brokerage account at any of those same three brokerages is the right next step. No contribution limits, no restrictions on withdrawals, full flexibility. For most beginners watching this video in 2026, the right starting sequence is capture the 401k match first, then open and fund a Roth IRA, then invest in a taxable account with anything remaining. Once the account is open, the next decision is what to put inside it. For most beginners, the answer is a single low-cost index fund that tracks the total U.S. stock market or the S&P 500, not individual stocks, not cryptocurrency, not sector funds or thematic ETFs or anything that requires an opinion about which industries will outperform. An index fund is a fund that simply holds every company in a market index. The S&P 500 holds the 500 largest U.S. companies. The total market fund holds thousands. When you buy an index fund, you own a tiny piece of every company inside it. When those companies grow, your investment grows. When they pay dividends, you receive a portion. You are not betting on any one company. You are betting on the American economy as a whole, which has a 100-year track record of long-term growth. Here are the exact funds to look for at each brokerage. At Fidelity, FZROX, the Fidelity Zero Total Market Index Fund. Zero expense ratio. Zero minimum investment. One of the most cost-efficient investments available to any American. At Vanguard, VTI, the Vanguard Total Stock Market ETF. Expense ratio of 0.03%. Broad market coverage. Decades of track record. At Schwab, SWTSX, the Schwab Total Stock Market Index Fund. Expense ratio of 0.03%. No investment minimum. Any of these three funds, inside any of those three brokerages, is an excellent starting point. Do not spend weeks comparing them. They are functionally equivalent for a beginning investor. Pick one. Open the account. Buy the fund. The decision you are postponing while researching is costing you compounding time. Here is the number that most beginners never calculate, and it changes how urgently you treat every step in this video. Every month of delay costs you at a 7% average real return, roughly 0.58% of what your final balance would have been for each additional month you are invested. That sounds abstract. Here is what it means concretely. If your investing target is to have $500,000 at retirement, and you are currently on track to hit that target, then every month you delay starting, you fall short of that target by approximately $2,900. Not from the market going down, from time running out. $2,900 per month of delay. The urgency of starting is not about fear. It is about arithmetic. The most common question beginners ask is how much they need to start. The honest answer is that the amount matters far less than the consistency. A person who invests $50 every month without exception will build meaningfully more wealth than a person who waits until they can invest $500 a month. Because the $50 investor starts compounding immediately and builds the habit that survives income changes, job changes, and every other disruption life creates. The practical starting point for most Americans is somewhere between $50 and $200 per month. At $50 per month, starting at 30, at a 7% average return, you have approximately $60,000 by 65. That is not retirement on its own, but it is $60,000 more than nothing, built from $50 a month, and the habit and account structure it creates is what you will scale as your income grows. If your income allows more, invest more. The percentage most financial planners suggest targeting is 15% of your gross income toward retirement, across your 401k and IRA combined. If you are not there yet, Start where you are and increase your contribution by 1% every time you get a raise. You will not miss the percentage you never had. This is the step that makes every other step actually work. And it is the one most people skip because it feels too simple to be the answer. Automate your investment contribution so it moves from your account to your investment fund on the same day every month before you have the opportunity to spend it on anything else. This is called paying yourself first. It removes every decision from the monthly equation. You do not decide whether to invest this month. You do not weigh it against a weekend trip or a new purchase. The money moves before those decisions exist. Almost every major U.S. brokerage, Fidelity, Vanguard, Schwab, allows you to set up automatic monthly investments in a specific fund. Set the date to 2 to 3 days after your paycheck arrives. Set the amount to whatever you decided in step 3. Turn it on. Then do not touch it. This one mechanical action, automating your contribution and leaving it alone, is responsible for more long-term wealth building than any investment strategy, any stock pick, or any market timing decision ever made by anyone. The investor who contributes automatically through every crash, every recession, every period of uncertainty, and every moment when the news says this is the worst possible time to invest, that investor is, statistically, the investor who wins. Set it up once. Then let time do the work that effort alone cannot. Let's come back to where we started. The average American who starts at 25 with $400 a month retires with $1.4 million. The same person starting at 35 retires with $540,000. $860,000 from 10 years of waiting. You are not waiting anymore. The 4 steps are straightforward. Choose your account. 401k match first, then Roth IRA, then taxable brokerage. Choose your fund, a low-cost total market index fund at Fidelity, Vanguard, or Schwab. Decide your amount. Start where you are, increase as you grow. Automate everything and never stop. None of this requires a financial advisor. None of it requires a large income. None of it requires a perfect moment, because that moment does not exist. It requires opening an account, choosing a fund, setting up an automatic transfer, and then staying out of the way while compounding does what compounding does. If this gave you the clarity to actually start, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. YouTube is going to show you the perfect next video right now. I will see you there.